larger.
All right. Welcome back, everybody, to another episode of the Tim and Tim Show every Tuesday at 10 a.m. Eastern Time. As always, with my favorite co-host, the other Tim Vest, who's on the road today, not in his office, as you can see. So, thanks for making the time and joining us today to have our weekly podcast that I just absolutely love doing. And this week, we're talking about why we're still buying multifamily in the Carolinas and side view of like why we continue to wind down operations and ownership in other states. It's just, the high level macro view here is that we love the Carolinas. We know it very well. It's a great market to invest into. And this week, we're going to go through a lot of the macro information of why that is, right? Like why is the Carolinas such a good market to invest into? Not just because everyone knows, California, Texas, and Florida, the Carolinas, Texas, and Florida are great markets to invest into. Like, let's actually dive in and talk about some of the macroeconomic data that supports the decision to continue to buy in the Carolinas and why we, as much as we haven't been able to buy anything in the last couple of years, we still want to, right? And we're actively looking. I mean, we've been making offers. We've gone under contract a couple times on different properties, but they didn't end up working out. But at the end of the day, our picture and our focus really has narrowed down on the Carolinas. And this week we're going to get into why. So without further ado, Tim Vest, how you doing today, man?
Can't complain. I think that's what I say, right?
Yeah, normally. Yeah.
Yeah. No, doing well. Happy to be on the road. I like getting out. So.
Oh yeah. Last week I was on the road a lot last week, so it's nice to be back in the office to kind of get caught up on some things. But so Tim, what do you love most? Like on a macroeconomic view, what do you love about the Carolinas, and why do you continue to want to invest in the Carolinas?
I mean, you can sum it up with one word, which is growth. I mean, at the end of the day, guys, you want to invest where the people are going, right? And they are. I saw a stat that was put out there, and you guys may have seen this, and I think a lot of people put it out there incorrectly, because there was a stat that showed that North Carolina had a negative 126%.
Oh yeah, that went around social media like wildfire. That image.
Yeah. So let's just correct that for 1 second, because if you think about it a second, you can't have a negative 126 population decline, right? Like, so first of all, but second of all, what that stat was saying was North Carolina's population last year, population growth slowed, right, by that number. It didn't mean that we didn't grow. We just, from 2024 to 2025 in comparison, it slowed, right? And so at the end of the day, North Carolina and South Carolina, the Carolinas, man, we're still seeing like a huge influx of people.
Mm-hmm.
And not just people, but business, right? And I also like North and South Carolina because they're kind of a balance for each other. Like South Carolina, you see a lot of like manufacturing and blue collar, and you see that in North Carolina as well, especially like in areas like Greensboro and Burlington and that kind of like central North Carolina corridor. And then on each side of it, you got Charlotte and Raleigh. And what Charlotte and Raleigh sees is like those companies will come in and put manufacturing facilities in South Carolina and that central North Carolina. And then they'll put their corporate headquarters in Charlotte or Raleigh. So you don't just get blue collar, you also get white collar jobs as well, executive level jobs. And it makes a really nice blend of different clientele that you can rent to and invest in. So again, at the end of the day, it all comes down to growth, and the Carolinas see a lot of it.
Yeah, I mean, I pulled up some stats so we can actually like talk about the data behind how many people, right? So North Carolina added 145,000 new residents from July 2024 to July 2025. Obviously, we don't have the July 2026 numbers yet. Total population of North Carolina alone is just over 11 million people at $11.2 million. 11.2 million people. North Carolina is the number one state for domestic migration, with 84,000 net new people from other states moving here. And it is the third largest total population increase nationally, only behind Texas and Florida, which are growing faster. Those are the number one driver that we look at when we are investing into a market is how's the population growth? And if the population growth is stagnant or declining, I'm way less interested in that property. And a lot of that decision recently the experiences over the last 2 years have shown me why that's important because for example, we own a property in Greenwood, South Carolina, and the population has been stagnant. Greenwood was probably one of one of the cities that got hit the hardest in terms of cap rate decompression over the last 2 years because it's been stagnant. There's been no real job growth. There's been no real population growth. Obviously, people are having babies and people are dying, so it's kind of flat, but there's not been really any real growth. And that impacts our business as LIHTC owners and operators because our annual median incomes are either flat or declining, and that ultimately impacts our rents over time. So having somewhere that has population growth is a big, big, big indicator for me because with population growth, you have job growth, right? Because
Yeah.
all of those people moving to those areas, they need places to work. And that means that people are investing into the area and it's trending up. So anywhere that
Yeah.
has population growth, likewise also has job growth. And those two things combined generally equal income growth. And you really need those three things as a trifecta to be investing in a really great market. And I'm not saying that I wouldn't buy another property in Greenwood. I'm saying the underwriting would look different, right? The
Right.
cap rate would be a lot higher for longer, maybe even stagnant over like a 5 to 10 year period. The rent growth might be 1% instead of 3%. It would look a lot different on an underwriting deal. And I'm not saying that we're not making money on these deals because we're doing fine on them, but they're not going to be as good as I wanted them to be. And that's fine too, right? Not every deal is going to be a home run. But if we had those things, like if something changes over the next couple of years where somebody opens up a bunch of manufacturing facilities and a bunch of distribution facilities or whatever in the Greenwood area, and you start getting population growth, you're going to start to have demand. There's no supply being added to that market. So by rules of economics, your rents are going to go up just because you're going to have job growth, rent growth, low supply, higher demand.
Yeah. Yeah. Absolutely. And then, Tim, I think one of the other things that kind of plays into that is because I saw this for some of the guys that were and guys, I'm not talking on the Midwest at all. I just don't invest there. But I saw one of the reasons for investing in the Midwest by some of the big operators out there was oversupply concerns in North Carolina specifically, and even more specifically where I'm sitting right now in the Raleigh market. Um, there was there was this concern that like Charlotte and Raleigh were overbuilding, right? Well, the reaction to that, which you and I have seen, and we dug into this quite a bit, is the reaction to that for a lot of builders is to scale back on building, right? And I think that's one of the things that you've called out here is that, hey, that has slowed significantly, right? And that's one of those macroeconomic factors that you were talking about. And so what you're going to see, guys, is the the new delivery pipeline is drying up, right? So there's less and less new builds coming online. There's less and less new builds being planned. And pretty soon, the population growth is going to outpace those new deliveries. There's not going to be as much housing. And hey, guys like us who own the existing housing, we're going to do quite well. And that timeline's not that far away. I'm trying to find it right
Yeah,
now, but it's like 2027 is when that
yeah,
we're going to see a big
2027,
shift.
2028. Yeah,
Yeah,
we've known this, but I've never actually seen the real data behind it because obviously
right,
it's always done in arrears. But we knew Charlotte was overbuilding in a huge way, right?
right,
And Charlotte delivered a record number of units in 20. We've been saying the last 2 years. 2024 was the peak of units that came online, which was 16,700 units came online in Charlotte. And the construction starts in Charlotte since then have dropped 40%. And
right.
they're only permitting about 1,000 permits year over year. And even Raleigh Durham, for example, they delivered 13,000 units in 2025, and next year is expected to drop down to 6,000 units delivered, a 50% drop, right? So what that's, so not only do you have 145,000 people moving to the area, you only have 16,000 units being delivered in Charlotte, dropping to, sorry, I don't have that figure, but in Raleigh it was 13,000 dropping to 6,000, right? So over 50% drop. So what you're seeing in the long distance view here is that people keep moving to the area, supply continuing to drop, right? Because it's a long tail, right? I mean, construction takes 2-3 years to complete. So, if you don't have any starts now, 3 years from now, you're not going to have a delivery. And as that continues to drop off, it gives the market time to absorb those vacant units and for rents to kind of stabilize again. And as the demand starts to go up and the supply continues to tighten, you start to have that rent growth again. But the problem is everyone got really used to looking at deals on a 2 to 3 year basis, and real
Yeah.
estate really needs to be on a 10-year basis, right? Or 10-year time horizon, I should say. And you're going to be fine over that longer 10-year period because you give the market time to absorb the market units, to go through the fluctuations of the ups and downs, to ride through any rate changes, like from the Fed level, if it's going to go up or down. Like everything has time to kind of even out over time, right? So time is your friend in the real estate market for sure.
Yeah, something you were throwing out a bunch of stats there. Something I thought was interesting because we lived through this. If you remember this, in 2024, when Charlotte peaked with those new deliveries, remember they all came online like in a 60-day window.
Oh God, yeah.
It was this crazy delivery window, guys, where Charlotte saw like 50% of its annual delivery dropped within like a 60-day window, and it was right towards the end of the year. It was like right between Q3 and Q4. And what I thought was interesting is we saw an impact, right? Like, full disclosure, guys, we saw demand for our properties drop, right? Because these were A class deliveries. We were in that kind of B, C class. We saw demand for our properties drop because they were running so many concessions for these A class and high end B class units. But the crazy thing is we're sitting there, we're like, hey, this is short term. As soon as these get absorbed, we're good. Well, Charlotte saw set a record for absorption in 2024, which is the year that happened. 12,000, over 12,000 units absorbed in a single year. And then pretty soon, I mean, that rent issue that we saw, that softening, really only lasted like 4 months. And by February, March of 2025, we started to see it pick back up. We started to see demand pick back up. We do a lot of voucher stuff, right? We started to see our vouchers, like we were setting record numbers on vouchers in the Charlotte market in 2025. Stuff that Tim and I were like, hey, we're used to getting, 1350. They're like 1460, 1500,
Yeah.
right? We started to see. So guys, it's just like, it's just a really good, stat. And then, a little bit of a lesson learned there that like, hey, just because this is happening in the moment does not mean that it's not a good long-term buy. To Tim's point, it's like you can't look at it in a 3-month window. You got to look at it in a 2, 3, 4, 10-year window. That's absolutely what we saw, and I think that's a really good example of it.
Yeah, 2020. I mean, shit, we could go back a couple of months, even a couple of years now. I've been saying that like 2020, 2029,
Mhm.
2028 into 2029 is when things will start to heat up again, and then 2030 we're back in a
Yeah,
solid, seller's market, right?
I think
A
so.
lot of these properties we're refinancing over the last 6 months, and we have a couple more coming up. That puts us in 5-year debt that expires in 2031. uh, that's going to be a really good time to sell. And it's difficult right now. It's hard right now with, we did see some occupancy drops. We saw rent softening. We saw insurance increases, utility increases. We saw taxes reassess in the Charlotte market. I mean, everything kind of hit us all at the same time. So it was very, very difficult. But I'm glad that we were able to get through a lot of these deals and get to a refinance and put them in long-term debt. If we had put them in long-term debt to begin with, our stress levels look a lot different. But yeah, the macroeconomic data behind why investing in the Carolinas for us still makes so much sense is it's setting records on both ends of the spectrum, right? Setting
Right.
records for absorption, setting records for deliveries, setting records for the delivery drop off, right? I mean, it's everything is in extreme right now because we're going through such an explosive period. I wish
Yeah.
things would kind of stabilize and be a little bit more predictable, right?
Right.
If they were a little bit more predictable, it'd be a lot easier and a little bit more comfortable in order to kind of make predictions on what we think is going to happen. But as long as we continue to focus on the macroeconomic level of information, then the economy won't steer us wrong, right?
Yeah.
The only thing that we need to manage at that time, if we can prove the increases in jobs, improve the increases in population growth, prove the decreases in supply, we just have to manage the expectation of the timeline. And what we
Yeah.
thought might have taken 3 to 5 years might take 5 to 10 years. But if you're going to make money still at the end of the day, it's okay, right? As long as there's a path to success. That's always been, I think, the biggest conversation I've had with investors now is what is the path to success? And we're talking a lot about these things about
You're right.
why the deals that we're buying in the Carolinas, they're going to be okay. Why do we believe that these are going to be fine in the long run, and managing the expectations of when that could potentially happen? Obviously, committing and guaranteeing nothing, right? But if history can show us anything, and the macroeconomic trends can teach us anything, that's what we need to rely on and kind of move, not the blame, but show like the path, right? Like if we
Yeah.
all know that these three things are correct, then the result is inevitable.
Well, and I think you're using the key word there, right? It's like path, right? And I think a lot of times, I mean, I'm guilty of it too, right? I think we all miss that whole path part of it. And guys, sometimes the path is not a 6 month flip, right? Sometimes that path is like 3, 4, 5 years. And hey, as an investor, it's hard to look at that sometimes, right? It's hard to say, okay, I know it's not doing well in the moment, but here's this path to success, and we're going to realize that 2 to 3 years from now, and here's why, right? And it's these numbers that you're talking about, it's this data that you're talking about. And Tim, the historically, history, there's a baseline here that history shows, right? Like history shows that when these things line up 3, 4, 5 years later, this tends to happen, right?
Hmm.
So using this data, using these numbers, and then saying, hey, I think this is a 3 to 5 year horizon where this is really going to start to pay off. So what that tells you is like own now, buy now, right? This is a really good time to be setting yourself up for 3 to 5 years from now. Um, and I think one of the hard parts though is like that investor sentiment right now isn't the best. Um, but one thing that you got to point out to folks is like, hey, is the time to buy when everybody's trying to do the same thing, or is the time to buy when people are a little bit afraid and you see something that others maybe don't see 3 to 5 years from now? I'll take the latter. um,
You know what's funny, Tim, though, is I have that conversation and everyone understands it, but very few are able to action on it.
right, exactly.
Everyone
um,
gets it. Everyone's like, yeah, I know, I know, I know. But it's scary and it's hard because it's difficult, right? Or
yeah,
it's uncertain. And investors they want return and certainty. And it's like, okay, well, I want to eat my cake and have it too.
yeah,
So what have a lot of a lot of investors had conversations with me about is like, you know, they understand now is a great time to buy, but they're kind of hurt from the last couple of years where things didn't really work out, and they want more cash flow rather than equity and depreciation. So, what does that do for an opportunity for Tim and I? That sets us up to be able to say, okay, well, we'll still raise money. We'll still, but instead of giving you equity, we're going to put you in a debt position instead of an equity
right,
position. And that
right,
debt position enables you and I to own 100% of the equity. So at a certain point in time, when the market starts to inflect and become positive, we can refinance that debt out. We can own it 100% ourselves. And, because we were willing to have that delayed gratification of when we were going to make money. And we know that most of the money is made in the equity, not in the cash flow. But again, it's
right,
having a balanced portfolio of some cash flow now, some equity pops later, and understanding what access to capital you have, what access to deals that you have, the way that you can structure deals is important, and just understanding how to
right,
use all of those tools. I don't want to say to your advantage, but it is to your advantage, right? If you can be patient and you can delay your gratification, you can use it to your advantage to to borrow money from somebody that wants to lend it on a debt position so that they can make money now rather than make money later. And I'm not saying that that's the right tool for every job, but just have an understanding of how to apply that tool when it could benefit you is paramount.
Yeah, I completely agree with you, and I think, man, I think that's something we kind of lost sight of. All of us lost sight of, back when things were so hot and heavy. Is that idea of like, hey, there's typically equity style investments and cash flow style investments, right?
Yes.
And rarely do you find like a really really strong blend of both. Something that's like going to double your money in 3 years that also spits off 10% annually. That's I don't know a ton of that. If somebody else does, please reply and tell us because I'd be curious. Um, but I just don't see a ton of that out there. And I think what you're talking about is a really, really good um, lesson for us all. Like, right, you got to have a blend, right? If you got a certain amount of money to invest, make sure some of it's spitting off cash flow for you, so that you can wait for the equity investments to produce. And and I think that's really, really what it comes down to. And one of the things that we're seeing here in the Carolinas is, hey, right now maybe the cash flow isn't as strong because there's some equity plays coming down the road. So we're setting ourselves up for the equity plays and investing in two really strong markets in the Carolinas. And then in the meantime, we're looking for some of those cash flow plays as well. So we're just like every other investor that's out there.
Yeah, I think it's important to note, like, it's still hard to buy deals.
Yeah.
There's still a big spread between what a buyer is willing to pay and what a seller is willing to sell for. Me as a buyer, I'm looking at your in-place rent roll, and I got to make sure that what I'm buying today covers the debt service. What sellers are looking at is, well, I bought this property for $100,000 a door, even though it's only worth $60,000 a door now. I still
Yeah.
want to sell it for at least 90. I'm like, well, I guess you're going to at least hold on to it for another 5 years.
Right. That's a that's a funny way to say it. Yeah, I guess you're going to at least, wait.
Yeah.
Um,
Obviously everyone's opportunistic to get their money out of a bad deal that's not generating income or that has a path to success. It's just how long are you willing to, endure that pain and that suffering before you're willing to just cut your losses. And I
yeah,
mean, I was at a mastermind event last week, and that was a lot of the conversation around was investor sentiment. It's hard to raise money, deals not performing. What have people done in order to, kind of buy time so that they
right.
could get to a point where the market has time to turn around? And then there's other people that were in the room of just like, I'm just tired of this. Like, this investment's not making me money. My business over here is making me a ton of money. I don't even want to deal with this anymore. It's like, okay,
Right.
well, you sound like somebody I want to buy from.
Yeah. And what's funny, Tim, is we're starting to hear that more and more. Like we've been talking, man, I feel like we've been talking about this for almost 2 years now. Like it's
Yeah.
coming, it's coming, it's coming. I think we're finally starting to hear the sentiment, right?
Yeah.
I'm tired of dealing with like this is costing me money. I'm tired of dealing with the headache, or it's not, or best case, it's not making me any money and I'm tired of putting my time into it. I think we're finally starting to hear some of that more
There's definitely a
consistently.
tolerance level, right? People are
Yeah,
reaching that tolerance level of willing to deal with it.
yeah, yeah. And I mean, folks are only willing to deal with things so long before they're like, this doesn't pay me. It sucks up a lot of my time. Just take it. Take
Yeah.
it from me. Right.
Energy. It
Uh,
sucks up a lot of energy.
yeah, yeah. And guys, I don't I don't blame people that feel that way. Because I mean, it's tiring. It gets very hard to deal with. But at the same time, sometimes hard comes with profit at the end, as long as you're willing to get through the hard. Um, so, it's just it's kind of what your goals are at the time. But man, like, so Tim, as we're kind of wrapping up here on the show, like, what are you thinking? What are you seeing with Vive for the next 5 years? Like, how's this going to help us out?
I mean, we right now we refinanced what, 6 properties in the last 6 months, and we got
Yeah,
another 4 coming up in the next 2 months.
to go. Yeah,
Yeah, that is setting us up. I mean, the last 2 years for us as an organization has been focusing on operations, focus on stabilization, focus on efficiency, focus on, execution, right?
Yeah.
And now refinancing into all of these long-term loans and also having the operational efficiency and execution is going to set us up to be able to sell properties for profit in the future.
Right.
And over the short term, we're still actively trying to buy stuff, right? We're still actively trying to buy stuff, but our metrics have changed, right? Our my tolerance threshold has changed. What I want in a deal has changed. And I'm way more selective and way more picky about what I want to do in the future. And I think that has really kind of opened up a lot of mental capacity. Not, I mean,
Yeah.
getting the portfolio stabilized and refinanced, that was its own Mount Everest of a task, right?
No.
Thankfully, we got a great team in place now. It has been a lot of banging our heads against the wall. A lot of, you've put in, God, man, so many miles on the truck, like, visiting properties and working with the team and really learning what it looks like, not only to be a leader, but how to inspire other people to make decisions and make decisions the way that we would make them, right? Kind of leveraging
Yeah.
other people's time. I mean, we've known it, but when you're owner of a company and owner of the property, it looks a little different. So
Yeah.
things have grown, things have internalized, things have changed, things have evolved. Implementing AI in our management company has opened up a ton of operational efficiency, which I'm
Right.
super excited about. And we're going to continue to, pull on that thread and see how far it can go in order to, kind of increase that operational efficiency. But then, we're kind of looking at maybe we start doing some third party management because we're on the, the front end or what was the term that they used at that conference we went to? The leading edge? Or
The leading edge.
hopefully we're on the leading edge or the leading edge side of the AI adoption. And maybe that's what we can bring as a property management company to the third party market that will, not only increase our opportunity, but also increase revenue for not only ourselves, but also, provide bonuses and take care of the lifestyle of a lot of our employees, which is obviously that's a huge importance to us. So, I mean, there's a lot of optimism in my voice because I am truly optimistic about where things are going. I think one of the biggest things that hit me when I really understood things are turning around, we're starting to see insurance reductions. And I'm
Oh
like,
yeah.
oh my God, how deeply involved I am in the insurance of our portfolio is really a true indicator to me of what property values are going to do. I mean, we've owned this one property down in Alabama for 5 years now, haven't made a dollar on it. But then literally overnight, our insurance renewal dropped by 50%. The property
Yeah.
value went up $400,000. Now we're looking at, hey, we can make a distribution because we don't have to pay all this money insurance. Do we want to
Yeah.
hold on to this thing now for the next couple of years and let it do its things and sell it for a profit? Or do we want to actually just get out of it and get our money back and move on? But it's giving me options now where I don't feel so pressured to like, no, I have to sell this to get my money back. Now I'm like, I think we've turned a corner. Selling it
Yeah.
now might be, shooting myself, might be short-sighted. So it's bringing options again. And I like options. When you're pigeonholed, and you didn't have any options or any outs, I mean, you just feel like you're barely treading water. That's a difficult spot to be in. And we were there for a very long period of time. So I'm hopefully optimistic that those times are behind us or at least kind of stabilized and that the
Yeah.
next couple, 2-3 years are gonna look like, things are flowing again, transactions are happening and deals will be getting easier.
But man, I think you just voiced something. You just walked through like the whole life cycle that I think a lot of people miss, right? It's like you went from I gotta sell, I gotta sell, I gotta sell it. And you didn't. And now here you are, you turned a corner and you're like, maybe I'm gonna hold on to it for a little bit. And it's
Yeah.
like you went through 4 years of like, we got to get out, we got to get out, and here we are, where it's like it's turned a corner, and you're like, all right, now I have options, and one of my options might be that I just sit on it for a little bit.
Mhm.
But
You're starting to see rent increases, you see expenses drop.
yep. So I think the lesson there is like it really sucks in the moment. Don't
Oh,
nobody that's watching this or
oh,
listening, don't get us wrong. It really sucks in the moment, but then you start to see that light at the end of the tunnel, and you're like, oh, this feels a
oh.
little better.
Ooh.
Yeah. And like Tim, like yesterday, we even had a conversation. And this isn't a property that's been struggling or anything, but like all of a sudden we were like, oh, I think insurance is going to renew here. And then
Oh god, yeah.
we get the quote, and we're like, it's like $42,000 less than we thought. annually, right? Put that
Yeah.
back on the NOI. What is
Right.
that? Well, how much value did we just get right there? You know?
Right. What? How much did we get back that we thought we lost? Is real.
Right, right. Like, and guys, like that's the kind of thing where $42,000 annually. And guys, this is not like a 200 unit property. This is like a sub 50 unit property. $42,000 annually, almost $1,000 a unit savings,
hmm
right? That's huge, guys.
Yeah.
Huge.
And if that's anything that's, if that's what's to come this year, maybe it won't be as aggressive next year, but at
Right.
least look the same or maybe even a
Yeah.
little lower. And
Yeah.
then you couple that with rents are starting to get a little stronger and absorption is continuing to increase the demand and reduce the supply. It's like, oh,
Oh,
it's
yeah.
working. It's happening.
Somebody told me if I just held on, you know.
Somebody just hold real estate for a long period of time, you'll be okay. Oh, this is it. This is what's happening.
This is what they were talking about.
Yeah.
Yeah.
I'm in optimistic spirits. I feel a lot better now. Like, we got over like a huge hurdle in our business that was a lot of stress on everybody, the team, me and you, the team, our wives, our families. Like everyone was feeling the stress of what we were
Oh,
going through as an industry and a business, and it was really, really fucking hard. It was hard. And I just
yeah.
feel better now. Like I feel like a load has come off our shoulders. Things are starting to get a little easier. And it's like, this is starting. I can see where this is going to start to get fun again. And I want to get back to fun.
Yeah. Me too. I'm a little tired of my wife looking at me going, "What is wrong with you?
Why
Like,
did you quit your job for this?
you're just angry."
All the time. You're on edge all the time. Well, all right, guys.
Yeah.
That's a wrap for today. Hope you learned something. Hope you learned why we buy our deals in the Carolinas, why we do, why we're wrapping up things, in other markets and continuing to double down in the Carolinas. What we think the future is going to hold for us, we have no clue. We have optimistic views of what could happen.
Yeah.
Time will tell ultimately, right? At the end of the day. But if the data and the macroeconomics can teach us what we're looking at into the future and why we think we're making the right decisions today, hopefully we are, and we'll let those things, and hopefully we'll let those things give us the tailwinds to ride into the sunset of success.
Oh, I like that. I like
Yeah.
that. That's gonna be our new on our shirt. We're gonna do some shirts.
I was going to say logo and slogan.
Slogan at the same slogan.
Yoo-hoo! Our new slogan.
All
All right,
right,
guys.
guys.
See you next week. Peace.
Peace.